Let's talk a little bit about current market conditions. Let's start here in Europe. How do you see things unfolding, particularly with the euro being weak again and the Greek crisis rearing up once more?
Well, for me it was kind of obvious that the US dollar would have to rise. I just read like 3 weeks ago the daily sentiment index, and they were only like 3 or 4% bullish on the US dollar. So everybody was extremely bearish on the US dollar. They had the problems with the the debt ceiling. By the way, the debt ceiling was raised I think 93 times during history, so it's pretty funny that there is a ceiling, even though they're kind of lifting it all the time. But from that point of view, the sentiment on the dollar was just extremely negative, and therefore it was kind of normal that it would have to go stronger. On the other hand, I mean, I think that the big factors right now is that everybody is kind of nervous about the end of quantitative easing part 2. Nobody really knows how things are going to work out afterwards.
But can it end? I mean, the US government is spending so much money. Where are they going to get the money if not from the central bank? It's not coming from revenue.
Yeah.
And a lot of people who had been traditionally lending to the government, like the Chinese, and Bill Gross of PIMCO now has supposedly sold all of his US treasuries.
Yeah. I think they'll grow out of the crisis. No, it was a joke.
Oh, okay.
No, I mean, in my presentation, I featured a chart, which like the official forecast from the CBO. And I said, okay, till 2021, there's going to be 8.85 trillion more deficits. So you kind of, it's not hard to figure out how the dollar is going to develop during such a time, and you just can see that those problems that we're having are just structural problems, and I don't see any reforms right now, and therefore I think that the next crisis is going to get bigger and bigger. I don't know if there's going to be QE3 immediately, but I think there's going to be something similar to QE, perhaps. They just create a new name. I think there's the saying in the States to put makeup on a pig.
Yeah.
And so there's probably another program because, as you said, who should buy U.S. treasuries for this kind of low yields?
Mm-hmm.
I would.
This is sort of like what Mises wrote about what was happening in Austria in the 20s. Central bank just printing. Well, in that case, printing more currency, whereas in the United States they're using computers to add zeros to the government's checking account. But essentially it's the same thing, isn't it? And Austria ended in hyperinflation. Is that going to happen to the dollar?
I don't know I honestly don't know the answer if it's going to be highly inflationary or even hyper-deflation, as Professor Fekete says, for example. I just know that the big experiments going on right now in dimensions that we've never seen before will trigger a crisis that is going to be pretty big. And I just know that gold is in a deflationary and in an inflationary environment. It's an asset you want to hold, and that's what I'm always telling our clients, that it's just a perfect portfolio insurance. Yeah? I don't suggest buying 100% gold or 100% silver, but I just think that you should be overweight in precious metals in this scenario when nobody really knows how everything is going to work out.
Yeah.
And especially, I mean, real interest rates are extremely low or negative, and in this environment it just makes sense to hold gold.
Yeah, if you put euros or dollars in a bank account for 1 year, you don't get enough interest income to offset the loss of purchasing power from inflation. Whereas in gold, holding gold, gold's up 10 years in a row against the US dollar at 18% per annum on average, if you can believe that. This is looks like another up year. So, clearly we're in a gold bull market, and I guess you agree with me that it's got a ways to go before this thing ends?
Definitely. I mean, at the very end of every trend, there's a trend acceleration, like we've seen, in the Nasdaq Composite, like 1999 and 2000, and in oil and so on. And I'm not sure if you can compare gold to equity indices or commodities, because for me it's not a commodity, it's money.
Yeah.
And that's what's really happening right now. I think this remonetization is currently happening. And like 3 or 4 years ago, when I talked to our clients, they were just asking, okay, what's your price target? How high can gold rise? So right now, the price appreciation is not why they're buying it. It's just to preserve purchasing power, to preserve wealth. And I think therefore it definitely makes sense to hold gold as a currency and not, as it's not a commodity, and you just can't print gold. And as I always say, it's a soft metal, but it's a very hard currency.
Yeah, it's a good point. I like to make this point as well about gold not being a commodity, that it's money. And the way I describe it is that commodities like crude oil and soybeans, they get produced and then consumed and they disappear. Even base metals disappear in the sense that they're dispersed in millions of applications and nobody tries to hoard base metals. But gold, even though just a small fraction of it is used in industry, it has this value. It doesn't get consumed. It doesn't disappear. All the gold mined throughout history still exists in this above ground stock. So that's why I used to distinguish gold as something unique. It's in this group of this class of things that we call tangible assets. Commodities are one kind of tangible asset. Gold is another kind of tangible asset that's called money because it doesn't disappear.
This stock to flow ratio, which is extremely high for gold, that's one thing I realized only a few months ago. So this is, for me, that's the biggest factor when you're talking about gold as a currency. So the high ratio between the amount of gold that was ever mined and the really small amount of gold that is produced every year, that makes gold so powerful. And you just got the same with silver, but for other commodities like copper or oil, it's completely different. Yeah. And that's, from my point of view, that's the point why gold is money. Yeah, the stock to flow ratio is very interesting. The way I describe it is like the above ground stock of gold, which is about 162,000 metric tons, grows by about 1 3/4% per annum. Exactly. Yeah. So you've got this consistency in this growth of the gold money supply, as opposed to the quantity of euros or the quantity of dollars, which 2 years ago the dollar's M3 was growing at 17% per annum. Now it's much lower, but it's all over the place. Whereas gold is just very, very consistent because of the natural consequences of gold mining. It's basically, I assume you agree with that. Absolutely, yeah. And that's also a factor why it's not that important if there's 100 tons more production every year. It just for the stock, it doesn't make any big difference. Yeah. Therefore, I think I just read that the gold stock grows approximately as fast as population grows. Yes. And that just perfectly makes sense. Yeah, so you have this consistency in gold's purchasing power over long periods of time. I've been told that just like today, an ounce of gold can buy a man's suit, an ounce of gold bought a toga for a Roman senator. So it shows that gold's been doing for a long, long time. The same thing, that preserves purchasing power, very useful in economic calculation, which actually was for me a very important part of my study in Austrian economics. The whole concept of economic calculation, making the right decisions as a businessman or an entrepreneur, using a form of sound money so that you know that the capital you're putting at work in an investment of some sort is actually being rewarded properly, or as you would expect that capital to be rewarded. And you have to do that and factor out when you're in an easy money environment that's been engineered by the banks, which is the whole Austrian business cycle theory.